Corporations are getting involved in enterprise risk management out of necessity. So many of the big issues that were left unmanaged are coming back to haunt companies. Traditional actuaries are involved in measuring the risk that companies are assuming. So if you're writing an insurance policy, you're trying to figure out the cost of writing that risk. Being involved in enterprise risk management goes beyond the boundaries of what risk you're assuming through your policy transactions to all of the other risks that are involved in either an insurance company or any other kind of institution. It doesn't necessarily have to be just an insurance company.
The actuaries are going to be more and more involved in enterprise risk management because of their broad understanding of the insurance environment, their understanding of financial markets, and their highly skilled technical abilities.
Some of the biggest trends that we see in the foreseeable future tie to how quickly capital can move around in the economy. We've seen companies have trouble maintaining their liquidity. They've had problems with their credit rating, managing some of their risks. And the economy and people, shareholders, are very quick to move their money out of industries or out of companies that don't have a great understanding of their risk profile. That will continue, and I think it's important for actuaries to help maintain a solid risk management profile, or else some of these companies will cease to exist.
The actuary's role in ERM, I think, will be to help continue to refine the models. I mean, the models will always be there. There are a lot of different models out there. Maybe we'll have a role in trying to narrow them down. But I think helping, again, our C-suite executives, if you will, to understand what they mean, to understand that there's always going to be something new around the corner, and be prepared for it and adapt to it when it happens.
There's nothing that says that actuaries are the natural, automatic profession to go to for ERM solutions. And there are others clamoring for attention in that space. Having said that, I do think actuaries, in the end, are very well equipped to fill that need, and I'm encouraged that the profession is investing in developing more of a reputation as ERM practitioners.
The transition to market-based accounting systems and economic capital are going to radically change people's view of what risk is and what it isn't. Right now, I think managers of financial institutions understand risk as something that could cause a fluctuation in their income statement, understandably. In the new world, with the new systems, what does and doesn't cause a whole new set of issues that will cause risk in the sense of financial reporting risk. And that will cause people to focus on a very different set of issues. Actuaries are, or should be, to the financial services industry what, say, the engineers are to any other, to the manufacturing industry.
The traditional models of the past, kind of looked at assumptions that are, well, in essence, unrealistic. The market is not rational. It really isn't. There is no such thing as fully diversifiable risk. You can't diversify things away that we thought we could. So I think over the next year, what the investment section and those that are in the investment industry in itself is to look at how to provide tools to model those types of risks, taking into account the fact that the market is inefficient, looking at the black swan risks and truly coming up with tools and alternatives to manage those risks.